Hey tech lovers, welcome to the Tuesday edition of Tech Stocks Daily. Ready to dive into today's wild ride on the NASDAQ? We're unpacking Logitech's unexpected stock drop despite stellar earnings, exploring Apple's price-slashing spree in China amid fierce competition from Huawei, and delving into CrowdStrike's cybersecurity powerhouse team-up with Fortinet. Plus, we'll break down what's behind Oracle's financial samba that has the market buzzing. So, whether you're scouting stocks to buy, hold, or just dabble in some finance meets tech drama, we've got all today's hot takes ready for you. Let's get cracking. All right, tech enthusiasts, let's talk about Logitech International SA and why it's making waves today. If you've ever used a mouse, a webcam, or a gaming headset, there's a pretty good chance you've encountered Logitech products. They're a big player in the tech accessories game, and their latest quarterly report is making headlines. So, what's the buzz all about? Well, Logitech just released their fiscal second quarter numbers, and while the company posted some solid figures, investors didn't exactly break out the party hats. Despite reporting an impressive revenue spike, up 6% to hit a cool $1.2 billion, topping both year-ago numbers and analyst estimates, a different narrative unfolded in the stock market. Shares of Logitech nosedived by around 8.5%. Why the plunge, you ask? It's all about investor expectations. Although Logitech beat earnings predictions and even revised their full-year guidance upwards from the previously expected range, it still wasn't the sunny forecast investors were hoping for. The revised revenue outlook landed in the range of $4.39 to $4.47 billion, just shy of analyst expectations sitting around $4.51 billion. It's like planning a barbecue but forgetting to invite the sun. Now let's zoom in a bit on the specifics. Logitech's gaming segment, always a fan favorite, saw a 7% increase while their keyboards and combos pushed up by 8%. Impressively, their new segmentification, bye-bye to audio and wearable and mobile speakers, hello headsets, showcased a broad demand. While their video collaboration unit climbed 5%, those gnarly webcams didn't play along, declining by 9%. Oh, but it's not all sweaty palms and sell-offs. The company's adjusted gross margin shifted to a strapping 44.1%, up from 42% a year ago, thanks primarily to lower product costs, which sounds like CFO music to any CEO's ears, right? Speaking of their cash reserves, Logitech's cash and cash equivalents stood at a hefty $1.36 billion, while they flexed shareholder kindness by returning $340 million through share repurchases and dividends. To paint the broader picture, the market might be a tad off today, potentially dampening investor moods. Hanneke Faber, Logitech's CEO, elaborated that the problem isn't the result, but perhaps the timing. They've lined up some proficiency-packed innovations ready to pounce, just in time for the holiday shopping frenzy. Looking at the bigger picture, if you were hunting for value-driven stocks, consistently delivering single-digit growth with the perks of a decent dividend yield, Logitech still checks those boxes. The lower stock price today could be viewed as an opportunity for investors looking to nab shares at a bargain. So there you have it, folks. Logitech took a tumble today, but perhaps it's just a speed bump, not a brick wall, as they say. Keep your eyes peeled, though. Tech stocks have been known to change moods quicker than you can say, wireless mouse. All right, tech enthusiasts, buckle up, because today's Apple news is all about discounts, AI delays, and David versus Goliath-style competition. First up, let's talk about those eye-popping discounts. Apple's been busy slashing prices like a beginner on a Black Friday spree. Yep, the iPhone 16 is now going for up to 1,600 yuan less on Alibaba's Tmall store in China. Why the sudden price drop? Well, this move coincides with Singles Day, which, for those who don't know, is the world's biggest shopping extravaganza. Apple is turning up the heat to win over cautious buyers, especially since the initial buzz around the iPhone 16 on Chinese social media could only be described as lukewarm, like sipping yesterday's tea. But wait, there's more. These discounts aren't happening in a vacuum. There's a big helping of AI drama in the background. Apple's on-device AI system is running behind schedule on speaking Mandarin. Oops, this little hiccup won't find a fix until next year, which might have left some potential buyers saying, "Not today, Apple." In the trade-in department, Tmall joins the fray with a subsidy offer that'll make your old iPhone's resale value feel like it just won the lottery. Fancy selling your soul to JD.com instead? Well, they've tossed in free AppleCare Plus subscriptions when you grab certain shiny new models. Pinduoduo can't sit this one out either and goes ahead to lower prices further. The price war isn't just happening, it's a lightsaber duel of discounts. Now, while Apple is massaging its market strategy in China, all eyes are on the hungry homegrown contender, Huawei. Following their 5G resurgence, they've outperformed Apple in terms of smartphone sales in mainland China for the first time since the universe was almost binge-worthy on DVD box sets, aka 46 months. Apple's usual dominance in iPhone sales has felt the pressure, like trying to keep a water slide plugged with a tennis ball. Switching gears a bit, Apple's also being dissected from a different viewport, its standings against fellow giants and little ankle-biters in the technology realm. Delving deeper, we find some juicy details about Apple's financial metrics. Compared to its peers, Apple's price-to-alla-radio-dormalism ratios, let me sound smart for a sec. Price-to-earnings book and sales ratios are riding Cloud9 higher than the industry average. This may ring alarm bells about overvaluation. But hey, Apple's stellar return on equity, mountainous EBITDA, and robust profits suggest it's generating profits faster than popcorn in a microwave. Despite having a sleek portfolio and gleaming gadgets that seem to practically sell themselves, Apple's been faced with slower revenue growth, comparable to waiting for a 15-second countdown to finish. Still, they've maintained a balanced financial structure, neither too in debt nor too kitty-happy with their cash reserves. In summary, Apple's got its hands full juggling lipstick-on-pig pricing strategies in China, AI language blunders, and a never-ending tech jigsaw puzzle with competitors. Can it maintain its sparkly Apple cool amidst new challenges? Oh, the drama never ends in Techland. Keep an eye on those charts, and remember, every bite has a story. Today, CrowdStrike is making headlines for two significant reasons: a strategic partnership with Fortinet and some fascinating movements in its options trading scene. Let's dive into it. First up, the big partnership. CrowdStrike has joined forces with Fortinet, a heavyweight in the cybersecurity and firewall game. This collaboration means that CrowdStrike's AI-powered Falcon platform will be seamlessly integrated with Fortinet's FortiGate next-generation firewalls. Translation? Your cybersecurity just got a massive upgrade. The Falcon platform is known for its powerful endpoint security components, while FortiGate is famous for its robust firewall protection. By joining forces, these two titans are setting a new standard in the cybersecurity domain. The key benefits? Customers are treated to a unified view of their security environment, which helps streamline operations and improve both threat detection and response times. Also, imagine getting real-time insights into your network traffic and user activity. It's like upgrading from dial-up to fiber optics, fast, slick, and super advanced. Daniel Bernard from CrowdStrike put it best when he referred to the union as a strategic partnership that thrives symbiotically. CrowdStrike's Falcon takes care of endpoints, while Fortinet holds strong at the network perimeter. Now on to the mysterious world of options trading, which has its fair share of drama today. Benzinga's squint-eyed options scanner detected some unusual activities surrounding CrowdStrike options. Investors are playing both the Jedi and the Sith. 23% of them are leaning bullish, while 30% have a bearish outlook. The spread of strike prices, ranging between 280 to 570, suggests the big players are expecting something big to brew. With trade volumes swirling around 951,468 in calls and 163,645 in puts, this level of chess-like market maneuvering is enough to make a cryptocurrency trader's head spin. What's more intriguing than betting both against and for a single company? Maybe it's the fact that this heightened action indicates potential developments in the tech company's immediate future. Often when whales start making such significant moves, the sea's about to change. Experts haven't been idle either, providing ratings and price targets ranging from $285 all the way up to $400. Interesting times are ahead for anyone with stakes in CrowdStrike. With a robust security collaboration with Fortinet and noteworthy activity on the options scene, CrowdStrike's story today serves as a timely reminder. Always keep an eye on the tech horizon. Whether you're a business bracing for the latest cybersecurity threats or an investor scouting the next big move, today's developments highlight that in both cybersecurity and finance, timing and preparation are the keys to knowing when to strike. CrowdStrike style. All right, folks, let's dive into why Oracle is stealing the spotlight today. Oracle is buzzing on the news circuits for a couple of reasons. Our dash into the heart of its corporate affairs shows it dancing quite an intricate samba of financial metrics and investor interest. First, let's unwrap the comprehensive industry comparison that places Oracle cheek to cheek with its software competitors. The financial breakdown provided by an insightful article gives us a peek at Oracle's muscle in the software industry. What's enticing here is Oracle's price-to-earnings ratio, sitting at 44.78, which is a hair's breadth more conservative than the industry average, indicating a little more runway for potential growth. On the flip side, the price-to-book ratio suggests a hotly debated point, whether Oracle's market valuation smells a bit too rich. Not content with just numbers, we also explore Oracle's EBITDA. Holy smoke, it's packing $5.44 billion, a staggering 1.93 times above what its industry peers are showing. Something quite captivating unfolds with their solid EBITDA and gross profits, highlighting Oracle's robust operational prowess. However, as we tiptoe past Oracle's low revenue growth of 6.86%, one can't help but wonder, are they just slow-walking the competition, or trying to find their zig to everyone else's zag? Moving on to Oracle's investor allure, these folks have sorted out how to keep a crowd entertained. Over the past month, the shares have surged 4.7%, overshadowing the Zacks S&P 500 Composite's gain of 2.8%. Despite some chit-chat over its low revenue thrust compared to the industry, Oracle's year-over-year earnings seem to be enjoying a healthy plus 10.5% uptick. The icing on this digital cake is the anticipation surrounding Oracle's earnings, expecting a year-over-year change that perks up to plus 11.5%. Though there's been a sneaky little 0.2% drop in projections lately, the bullish trajectory remains predominantly intact, showcasing an expected earnings change set at a juicy plus 13% for the upcoming fiscal sparkle. Despite its somewhat divisive Zacks Rank 3 rating, indicating a steady, albeit not scorching hot path, Oracle isn't showing signs it's going to park its growth bus just yet. Their balance sheet is still proving mouth-watering to many investors, curiously poised towards its future route. Now I toss the Oracle crystal ball in your lap. What do you folks think about Oracle's recent shenanigans in the tech world? Reckon it's ready to leap over its hurdles, or still needs a bit more software polish? Scroll down to the comments section and let your voices crescendo there. All right, listeners, if I had to pick one stock from today's tech news and decide whether to sell, buy, or hold it, I'd take a closer look at Logitech International SA. Now hear me out. Logitech shares took a nosedive by around 8.5% despite beating earnings predictions and revising their full-year guidance upwards. So you may be asking, is this the time to panic or pounce? Here's my take. Given their consistent growth in key product areas like gaming and keyboards, along with an impressive jump in margins, up to 44.1%, Logitech seems pretty robust in terms of operational efficiency. They're also sitting on a hefty cash reserve while continuing to distribute shareholder returns via dividends and buybacks, which is always a good sign. However, this spunky decline might scare some investors away because of the slightly underwhelming revised revenue guidance, not to mention some market pessimism in the broader tech sector that's looming large today. But here's where things get interesting, folks. This slide could spell buy for those of you thinking long-term value. You're essentially getting a company performing well in a well-liked industry segment at a discounted price. Now, taking the bird's eye view, those innovations queued up for the holiday season might just bring the sun back to this BBQ. If you appreciate a bit of risk and are a fan of picking up stocks when they're a bit bruised, but still solid under the hood, adding some Logitech shares to your cart could be an interesting move. Whether you're ready to take the leap or prefer keeping your dry powder for another day, remember, this is not investment advice. Always do your own research before diving into any stock. And now, over to you. What's your take on Logitech? Leave a comment with your thoughts. Today's market activity was a roller coaster of emotions for tech investors. Logitech threw us a curveball with its stock dip despite strong earnings, making investors question their next move. Apple dove into a discount frenzy over in China, while also finding itself in a tug-of-war with its AI and Huawei rivals. CrowdStrike's shook hands with Fortinet for an epic cybersecurity partnership amid some entertaining stock option drama. Lastly, Oracle performed a nifty dance with investors, showcasing solid profits even seemingly at a jog, not a sprint. If you enjoyed today's tech escapade, remember to hit that like button, subscribe to the channel, and share the video with your fellow tech enthusiasts. Can't wait to catch up with all of you tomorrow for another round of the hottest tech news.